Welcome back. It is the start of the Samvat, and therefore we're not discussing economy. We are going to discuss markets, of course, built on how the economy is panning out. And we have someone who has observed both very closely for a very long time, I think 3-4 decades. We have with us Anup Maheshwari, co-founder and CIO of IIFL Asset Management. Of course, we know him from previous avatars as well. He has been on a bit of a banvas for the last 4 years. We haven't seen you, Anup. So thank you very much for coming to our studio.
Thanks for having me.
Okay, let me start with the micro and then go to the macro. Can you tell us about IIFL's asset AMC piece itself? We don't get to hear too much about the MF piece. So tell us, what is the MFPE AIF split and how have each of these pieces been doing?
Sure. Yeah, so IIFL, we've been growing a bit quietly over the last 3 to 4 years. I came in 4 years ago. And we're the leading alternates player now in India. Alternates is becoming a bigger and bigger part of global AUM. More importantly, if you actually look at global AUM and revenue, it's pretty interesting at an international level. So global AUM is about $100 trillion and global revenue on that AUM is about $330 billion.
Oh.
Now, alternates is 15% of global AUM, but 45% of global revenue. So it's the most profitable piece in asset management. And that's the area we are focused on. Alternates basically mean everything that is unlisted, illiquid. So within our alternates book, we've got private equity. We're one of the largest domestically sourced private equity firms. We have structured credit, which is a very interesting business, high yield credit, real estate, residential debt. And we also have a public equities piece. Oh. So all put together, we're about 56,000 crores of assets. We've grown quite strongly over the last 4 years. We've got about 13,000 going to 55, 56. And within that, our alternate investment funds, that structure is the largest piece. That's about 30,000 out of the 56,000. So it's been pretty nice. The last 4 years have been good. And it's very exciting to be in this space because it's growing quite rapidly in India as well.
What has that returned?
So the alternates across various books, private equity has been somewhere in the 18 to 20% IRR range. Our listed equity is doing quite well. We're sort of in the top quartile decile. Okay. And on structured credit is also decent yield. So all the books have done quite well so far, but it's a young track record. There's a long way to go.
No, I agree. And especially funds like these, structured credit, you have to look maybe at a longer period. But Anup, now let me come to the macros. What's the sense you're getting in terms of global equities? We've seen some kind of a bottom formation in the big markets, in the developed markets. Do you think that the worst is over, or is this just a bear market rally?
Sure. Well, it's difficult to say the worst is entirely over, but the fact of the matter is a lot of the concerns that we have, are well understood now. I think people broadly understand at least the economic concerns. Geopolitics is a very different topic, but the fact of the matter is that a lot of that is represented also in global markets. Valuations have come off to more meaningful levels. We've gone through the interest rate hike cycle. Everybody is expecting a recession already. So, the good thing is sort of within 24 hours, everybody has the same view pretty much. And it's fairly priced in. So there is a chance, of course, things can get a bit cheaper over time. But I think the bulk of the impact has been felt already. So it's really in increments now. And in these periods, you're much better off doing bottom-up investing than taking too much of a top-down view. Okay,
so let's come to sectorally. Since you are anyway engaged in several of the interesting sectors, let's start with real estate. Is there a lot more opportunity in the listed space, or has the market already priced the fact that we are at the start of a good real estate cycle?
Sure. So real estate, to be perfectly honest with you, it's not an area that we've focused much on in our portfolios, for the simple reason that we struggle to find companies in that sector that are capable of delivering more than a 15 to 20% return on equity. Just the nature of that business is such that they don't really produce high return on capital because a lot of it gets redeployed into buying fresh assets. So it's not a sector we've really built much in the portfolio. But having said that, we've all seen the same trend. It's consolidated, therefore the economics for the larger players are improving. The only concern, I guess, is as rates start rising and interest rates are rising here as well, that tends to obviously have some impact incrementally in terms of demand. It's bound to have some impact on demand at some point in time. So I guess there are a couple of good choices in the sector, but frankly, we don't hold any right now.
Okay. Well, then let me not try and guess the wrong sectors. You tell us, where are the opportunities now, whether it's AIF or the listed space, preferably listed because
Sure.
that's the viewership.
Sure. So, the largest sector in India, and it's interesting actually, if you just take the big picture sort of thought process, two sectors in India matter a lot. Financials and IT, interestingly, make up 50% of India's wage bill. If you look at corporate India's wage bill, the BSE 500 total salaries or wages, 50% of that comes from these two sectors alone. And therefore, how these two sectors perform is very important because that influences the whole consumption cycle and the broader sectoral outlook. So the good news, I guess, is financials is doing quite well. And we've seen from the spate of results last week that things continue to be on a fairly good trajectory for financials. It's 1/3 of our market cap. So therefore, when financials are doing well, that provides some, sort of safety net or some consistency to the market. IT, of course, is going through more challenges at the moment compared to last year, and maybe valuations are still a bit above average. So we have to wait for that. But from a business point of view, I think things are steady.
Okay.
So, so from our point of view, financials remains one of the very interesting long-term sectors to, if you're playing India or investing in India, this has to be a core part of your portfolio. Beyond that, we're looking at pharmaceuticals. We have a bit of a soft spot for pharma, although it's not done very well. But I think as a sector, it does tend to create long-term value. So within pharma, we're finding some interesting opportunities. Some of the consumer discretionary names look interesting. So at a broader level, I would say the good thing is it's fairly broad-based. It's not just one or two sectors. It's a fairly broad swathe of companies and sectors. But finally, it's more what you select. So the bottom-up side is more critical.
Yeah, of course. But still, if you can talk stocks, nothing like it. But you have your compliance rules. Finance, I think the top echelons are well-founded. There is very little now to discover about HDFC Twins or about their merger details or ICICI or Kotak. If you were to go down the line, will you go down the PSU Bank line because BOB is at a 52-week high? Canada also, I think, today is at a 52-week high, other than SBI, of course. Would you go down that line? Would you go down the line of NBFCs? Or would you go down private sector mid-caps?
So the longer term sort of buy, hold, core portfolio would be around the same private sector banks. I think they've demonstrated more consistent ROAs, ROEs, incremental market share, and that trend I don't think shifts, that continues. For the other parts of the market, I think it's really more a valuation call at a point in time. So sometimes they get so cheap that they're worth owning for a while. Yeah, that's the way we generally see it. The largest public sector bank, of course, comes quite close to the private sector banks in their metrics, so that I would include in this category of private sector. But yeah, beyond that, I'd say we take more tactical views than long-term structural views. I think the core really is that, and they may sound like the same old boring names, but they've been consistently creating value as well.
So why try and look in the difficult space? Fair enough. Let me come to the mutual fund sector itself. I know you said that it's a smaller piece for you, but now interest rates may start looking attractive, especially of the large NBFCs, the well-run NBFCs. They will start or have already started asking for public money at much better rates. Right. Do you think that the very good run that equity fund flows have seen could be a bit challenged and fixed income could attract?
Sure. No, it's bound to moderate somewhat, Lata. I mean, if you look at last year, the flows into fixed deposits fell substantially, and in a way was redirected partly into equities. And as FD rates go up, it's quite logical to assume that some flow will go back. And mutual fund flows have already started tapering off a little bit. So there's no arguing about the structural trend of under ownership in equities, but yeah, the same velocity. I mean, it might sort of diminish a little bit before it picks up again. So that's bound to happen after a very strong year of flow, and as interest rates rise, then the options start opening up a bit.
Okay. Well, finally, about this K-shaped recovery. The economy is doing well, but it looks like one part is doing way better and others have lost out. Would that be one way in which you choose stocks? Catering to those who can, those who, the affordable class, consumer discretionaries, the titans, etc.
Yeah. So, the K-shaped recovery is nothing but more than a further extension of this unorganized to organized shift that was already happening and has got even further accelerated in a way. So, yeah, we are looking at the more larger organized players benefiting. Some of the underperforming parts of the market, like the rural side, rural India has been a bit more challenged of late. But to our mind, that's largely because some of their cash flows have been redirected towards the moratorium repayments. But now that this phase is over, there's a good chance the consumption side of rural will pick up again as well. So I think going forward, we are focused on consumer discretionary, as I mentioned earlier. That's an interesting area. And most of the other sectors that we've discussed. But I think at a broader level, demand, I think, is continuing to remain reasonably okay.
Okay. Well, just a final question, and we have to do this because this is Samvat Times and It's a market show. What's the annual return a viewer can reasonably expect?
Yeah.
I mean, we are at what, 17,700? We have seen 18,400 a year ago. Yeah. But the year ahead looks like a 10% return, looks like a high single digit, or looks like double digit.
Yeah, it's tough to predict year to year. I haven't come across anyone in my 27 years who's got the years right. But I mean, just to put in context, we are slightly above our long-term average valuation. The rest of the world, of course, is way below. So India's premium to the rest of the world is quite high. So we have to keep that in mind. On the earnings front, we are absolutely okay. It looks like we are still in that 14-15% earnings trajectory. I think it's really more a valuation call. Our sense is, we're still on a very good track over the course of the 7-8 year period. It's difficult to predict year to year. Last Samvat was sort of flat at the end of it. So hopefully, as long as it's not significantly down, which is unlikely, I think we're looking at any consolidation rise is great for long-term investors. Okay. So, yeah, that's the way we are.
Thank you very much. I know this discussion can go on and on, but it's a pleasure having you with us after a long time, and have a great Samvat yourself. We wrap up on this edition of Bazaar. Thank you for watching. Trading ideas coming up for you on Chartbust.